This is David Ranson, and this is our August webcast for clients on the theme of inflation, commodity markets, and energy investments. Contrary to popular belief, increasing energy prices are not a wild card that boosts inflation and retards economic growth. Largely, they're a painful consequence of inflation, or a natural consequence of growth, and sometimes both. Our present situation is one in which these two factors are at odds. High inflation and low growth are pulling the prices of oil and other commodities in opposite directions. Inflation, though, is winning. This is the title of one of our reports from some years ago on this subject. And my first exhibit shows the price of oil historically. As elsewhere in the sciences, empirical connections are easier to see when viewed from a great distance. Take the price of oil as an example, something that is often seen as a wild card. One of the best ways to understand it is to trace its price history over very long periods of time. And my first exhibit shows the prices of crude oil, gold, and industrial metals over the past 7 decades. The close parallel between oil and gold can only mean one thing. Both are commodities whose price movements are telling us how the value of the dollar is changing. That would explain why industrial metal prices move in parallel as well. In other words, the price of either gold or oil is more accurately understood as an inverse measure of the dollar. Commodity prices are far more stable over time, in real terms, than it may seem. It's the currency in which we express them that supplies most of the variability. The lesson here is that the dollar's depreciation is more important than any other factor in driving oil and commodity markets in the long term. The popular idea of a supercycle in energy or commodities is a misconception. There is a supercycle in inflation. In the shorter term, the parallel between oil and gold prices is inexact, of course. That's where economic growth enters the picture. Growth tends to boost energy prices, but not gold. The price of gold does best in times of low growth, when it serves as a safe investment haven for capital fleeing from equity markets and other risky assets. That's why Exhibit 2 shows substantial short-term slippage between oil and gold prices, but still within the confines of a long-term proportionality. Under present circumstances, the magnitude of prevailing inflation to push up the price of oil is greatly overpowering the power of weak growth to pull it down. The price relationship between oil and gold can be pushed back into the past as far as 1870, when the market for crude oil was very new. And it works the same way all the way back. Exhibit 3 includes the gold-oil ratio, showing how volatile it is in the short term. But however variable, it's clear that it is norm reverting, and so is the economic growth rate. Economic growth explains most of the movements in the gold-oil ratio, not all. At present, the gold-oil ratio is lower than it has ever been, suggesting substantial potential for higher oil prices. Further evidence of the centrality of gold for commodity markets appears in the next exhibit 4. This shows the cross-sectional correspondence between gold in local currency and the level of consumer prices. The countries included are from the emerging world. That's because that's where the greatest extremes of currency instability are to be found. The inclusion of really extreme cases such as Brazil and Argentina adds a lot to the statistical fit, thanks in part to the use of a very long time frame, 42 years. The connection is as close to a perfect statistical relationship as these things ever get. Another insight that can be inferred from the chart is the inflation rate that a country would experience if it were to fix the value of its currency in terms of gold? The answer is clearly zero, but there aren't any countries that have done that. The message of the previous slide is that inflation is proportionate to the decline in the value of a currency. There's more than one metric, though, in which to measure that. Exhibit 5 shows the very different paths followed recently by 3 different measures of the value of the US dollar. Relative to foreign exchange, the dollar has been rising, whereas relative to spot gold, it has been going sideways. The third benchmark is a unique indicator introduced in recent HCWE publications. It's the value of the USD relative to gold in distant forward markets, and it often moves very differently from the spot price of gold. It's the only one of the 3 in the chart that correlates with the inflation surge. The reason for using a different gold price indicator is the need to mitigate a major problem with the spot market. This is the familiar tendency for the prices of gold and other safe haven assets temporarily to be boosted by anxieties and safety seeking associated with geopolitical events. The COVID pandemic was one of the largest examples of a geopolitical event ever seen, pushing gold up enormously in early 2020. But gold has been coming down ever since. Safety seeking is less of a factor in forward gold markets, and at horizons as far out as 30 years, it disappears. That would leave the market free to price the inflationary effect of the dollar's depreciation more accurately. Exhibit 6 shows futures 5 years out and estimated forward prices 20 and 30 years out. The longer the horizon, the more differently the price behaves relative to spot. The forward price of gold for a distant horizon has successfully explained inflation historically and serves to predict it as well. Exhibit 7 shows the monthly historical relationship between producer goods inflation and the 30-year forward price estimated from the yield curve. It consists of a close correlation not only contemporaneously, but also with inflation 1 month into the future. Thanks to the 1-month delay in government reporting of inflation, predictive power actually goes out as far as 2 months. The success of this as a leading indicator of inflation has continued throughout the pandemic period and right up to the present. Now, the capital markets. The ability to predict inflation carries over to predictive power for many parts of the capital markets. Exhibit 8 shows monthly data for 3 commodity-related markets: raw industrial materials, crude oil, and the stock prices of energy companies. Months in which the forward price of gold rose are separated from those in which it fell. That's a primitive way to distinguish a high inflation scenario from a low inflation scenario. And then for each market, the graph traces the total return trajectory for the 2 data groups separately, allowing for the consequences to diverge as far as 4 months into the future. The green line shows the high inflation scenario, and the red line, the low inflation scenario. In each graph, the divergence between the red and green lines is immediate and impressive, proving the predictive power of the indicator, but it reaches a maximum in at most 3 months. The next exhibit will be very familiar to most clients. We call it a compass chart for studying and guiding asset allocation decisions. It provides a broader picture of the implications of a rise in the forward gold price. The 1-year change in forward gold is plotted horizontally, and the 1-year change in corporate credit spreads, which are a forecaster of growth, is plotted vertically. The current situation is indicated by the caption inside the red rectangle pointing to a particular pair of coordinates. It's pointing to a position on the grid that implies a number of asset classes, shown in the background, to be favored. It's particularly favorable for commodity markets in general, and energy prices in particular. A favorable outlook for commodity and energy prices famously implies high returns from energy stocks. Exhibit 10 shows how movements in the crude oil price are related to returns from the S&P Energy Composite Index on a year-over-year basis. It divides the annual history of oil price changes into 5 separate data groups according to the degree of change. The contemporaneous return from energy stocks is shown for each group. For these annual data, the correlation is 0.6 and statistically very significant, but for monthly data, it's only 0.3. And there is very little scope for predicting equity returns from movements in the price of oil. They're contemporaneous. For forecasting purposes, therefore, it's necessary to turn back to the forward price of gold. The bulk of the market capitalization of the S&P Energy Index is attributable to the oil, gas, and consumable fuels subsector of the industry. But this is not where the biggest impact of a rise in the oil price is felt. Exhibit 11 shows that the equipment and services subsector is boosted considerably more. That's no doubt because an equity position in a company is an investment in the entire balance sheet and not merely an opportunity to benefit from an oil price increase. For the major energy companies, costs rise with inflation nearly as fast as revenues. Exhibit 12, the last exhibit, separates the energy composite further into several smaller sub-industries. The oil and gas drilling industry has the highest correlation with the price of crude oil. The industry that is most sensitive to the oil price is oil and gas exploration and production, with oil and gas drilling close behind. Energy equipment and services are twice as sensitive as the Composite Energy Index. So current circumstances favor these sub-industries very substantially. That's the end of our August webcast, and I look forward in 2 months to talking again on another topic. Thank you.